Vetri Subramaniam is Chief Investment Officer at UTI Asset Management Company. He's with us. Vetri, good morning. Great to have you on the program as always. Prashant this side. Are we heading up or are we heading lower, Vetri? Simple question. It doesn't get more simpler than that. From here, where we are, sort of, is it? And the question I asked that question is because even though last week markets lost a little bit of momentum, they've not really done badly at all, given all the noise around tariffs, etc., and all the other stuff, right? Earnings which have been poor, which continue to be. This quarter is going to be nothing special. So, which way are things weighted, in your opinion, Vetri?
Morning, Prashant. Well, I wish I knew. It's impossible to say what the market will do any given day or any given week. But I think, we as a mutual fund, are looking to deploy money for investors over the much longer term. And I think when you look at that, you have to look at, where you are in terms of the starting point, in terms of valuations. It's a little bit more of a mixed picture over there because, valuations are sort of in the fair value zone when it comes to, benchmark indices like the Nifty 50. But I also think this is a market in which it's more about getting the stock selection right rather than just a top-down focus on, market valuations or single stock valuations. So I think I would just describe it as challenging territory. And I would suggest that the main thing is for investors to have very moderate expectations from equities, given the current starting point in terms of valuations.
That's an important point. Vetri, hi, good morning. And we'll talk about some of the micros in a bit. But on that point, where markets are and how markets have reacted to all the tariff news as well, right? And now the letters that are going out, at least the printed rates are 25%, 30%, 50%, depending on which country you are. But the market has remained completely unfazed. What would your observation be on this? Is this a sign of wisdom, or is this a sign of overall market complacency, which then maybe could be a new risk?
But let's just slice and dice it a bit. I think clearly, all the factors that you're talking about has heightened the uncertainty in the marketplace. It's heightened the uncertainty in terms of corporate decision making. So, I think clearly we are seeing companies hold back on large capex announcements because of the fact that the global value chain is now splintering. And this is particularly true of, large investments in the tradable goods area. I think this is true not just of India, but even on a global basis. Any entrepreneur is doing the obvious thing when faced with uncertainty. It's a little bit like driving in heavy rain in Mumbai. You just slow down simply because your visibility is so much slower. And I think some of that will translate into slower decision making. It will show up in the earnings. And it's interesting since you mentioned, earnings, the market sort of back to where it was, 7, 8, 12 months ago. But in valuation terms, even though you've rolled forward a year, in valuation terms, it's not really cheapened very significantly. And I think, therefore, given the risk to earnings, I would still worry a little bit about that. In a global context, it's quite interesting because when you look at the US, the bond market is talking about 2 rate cuts through the rest of the year, which suggests the bond market is expecting softer data. But you look at the equity market, and the cyclical component of the equity market in the US is significantly outperforming the defensive part of the equity market, which is a little bit of a dichotomy that you've got the bond market pointing one way and you've got the equity market pointing the other way. And sooner rather than later, only one of these theses is going to play out. Both can't play out.
Absolutely. I guess the equity market only wants to read one way, and that is up. Whether you talk about real wars or trade wars or currency situation, inflation, the equity market just wants to read up. By the way, our market is flashing down. I just wanted to, as I hand it over to Nigel, we're almost a 90-point drop now on the index. Watch out for a sharp fall in stocks like Bajaj Finance and further cuts on big stocks like L&T as well. And IT anyway has been weak. So it's now turning out to be slightly lower after the start.
All right. Hi, Vetri. Good morning. Good to see you, Ben. You're sounding a little bit cautious on the headline index itself. So you wouldn't be in the camp that believes that mid and small caps are the way to go. I was reading a note from Motilal Oswal earlier this morning, and they have said that after a while, they are feeling a little better about mid and small caps because the earnings growth will be far better than what the large caps will do over the next 12 to around 18 months, so 18 to 24 months. How would you position yourself in terms of investments in the equity market?
So if we just roll that back, Nigel, look, all returns that you got out of equities are a function of where you are in terms of starting valuations and then what you get in terms of earnings growth. There is some evidence that, I would say certainly looking at the quarterly outlook, that the earnings prospects in the current quarter, or rather the quarter completed, are better for mid and small caps compared to large caps. But if I look at the FY26 numbers, I'm not able to see a very big gap. And therefore, given that the starting valuations are already a lot more elevated in the mid and small, I'm not sure that the superior earnings growth by itself will do enough to outweigh the pressure from the starting valuations being higher. So you've always got to look at it in a combination. The market is never driven by a single factor. It's always multi-factor. And I would say the two key elements that I as an investor have always learned to look at is where are you in terms of starting valuations, where are you in terms of earnings growth. So you've got to look at both together rather than only where is the best earnings growth. And history is replete with examples about, companies which have compounded earnings growth at, very healthy levels. But when their starting valuations are elevated, you don't get the benefit of that simply because, the stock derates over a period of time. So that's the complexity you need to keep in mind.
Yeah. The thing is, now the market seems to be grappling on both fronts, trying to find pockets where valuations are reasonable and trying to find pockets where at least you'll get some half-decent earnings growth, right? So, Vetri, help us out over here. I remember our earlier conversation. Financials, for instance, is a space that you've always liked. There's a big debate on FMCG now because FMCG stocks have not moved. Many believe that earnings from that very low expectations era will at least be better than what they used to be. But do you believe so?
Yeah. So just quickly on both, I think as far as financials are concerned, Surbhi, we spoke more than a year ago. I think two big changes that have happened since then. One is that the RBI's thought process in terms of interbank liquidity has changed dramatically. The other thing which has changed is their approach towards risk weights. The way I interpret that is that they are now a lot more comfortable that the system has been cleaned up, and therefore they would be a lot more amenable to actually see credit growth accelerate. And I think that would be a wonderful thing for the financials. It's not yet happened. Credit growth is actually barely running at about 9% in line with nominal GDP growth. I would say, in fact, it's quite weak. But I think the trend line from here is likely to be higher simply because you've got RBI now clearly indicating in terms of its actions that they are amenable to higher credit growth. And I think that is good for the banks along with the easy liquidity. As far as FMCG is concerned, I know the stocks haven't done much in recent years. The other reason to look at them is that they're a little bit distanced from all the stuff that's going out in the context of, value chains and global trade and tariffs and all of that. But I just feel that the starting valuations there are still not really at a level which gives me great comfort. If I were to look at a sector where I had more relative comfort, I would actually say the Indian healthcare sector in general. And you remember the Indian healthcare sector is very well diversified now across domestic drug producers looking at global markets, the CDMO type companies who are doing contract work. Then you've got diagnostics, you've got hospitals. So I think that's a sector which, to my mind, slightly remote from some of these other issues, and at the same time, very diversified set of companies which is reasonably well placed to do well over the next few years. So banking and finance followed by healthcare would be my preference.
I think absolutely, Surbhi, on that financial point, we've of course seen this big pivot from the RBI, which I think has been well acknowledged. I met a couple of bankers over the weekend, and the RBI regularly calls for feedback, right? They'll ask and say, what else can we do? Yes. Sense I got is that they are really eager. Tell us what we can do to spur growth. So they really want to kickstart another credit cycle. That's the clear message.
Which bodes so well, right?
Which bodes well. They really want to push growth. And one person said, well, I've not seen this kind of an RBI.
Focused on growth.
Focused on growth in a while, So I think that existing regulations, can we repeal some of it? Some things you think are draconian, et cetera, et cetera. Things like PSL. So we've discussed some of this in the past, but I think and I think that is one reason why many who we speak to regularly are quite kind of focused and bullish on financials as a space. But the point is, if credit growth picks up, I mean, it shows up everywhere.
Yeah.
It's just that banks are economy facing and kind of it shows up there first.
Yeah, I think we were talking a lot about the Fed pivot. Well, all eyes were on the RBI. The pivot came here.
That's what I said, right? We were joking about it. Remember that Mr. Trump, maybe he'd want to take a leaf out of our RBI governor's book and send some lessons to Mr. Powell. That's on a lighter note. But thank you very much, Vetri. Great conversation as always. So we'll keep our eyes very focused on financials to see how it starts playing out in numbers. The RBI is a new, far more supportive and accommodative stance with respect to growth. So thanks for that.